Mike built DataFlow from the spark of his own ambition. With risky bets and all-nighters in a cramped garage, he engineered the company into a thriving $25 million enterprise. In boardrooms and on quarterly earnings calls, Mike wore his victories. But the world of success has its monsters. For Mike, the dragon was not a rival corporation. It was the lurking IRS and its cold demand, an estate tax ready to consume 40% of everything he'd built if he were gone. The bill was so steep, his own children would be forced to auction off DataFlow just to pay it. DataFlow had mutated into a ticking financial trap for the family he'd hoped to elevate. The more DataFlow triumphed, the more it felt like he was building an inheritance for the government, not his own blood. If he did nothing, his success would become his family's burden. One crisp winter afternoon, Mike sat across from his attorney. She took a napkin and slowly drew two circles, one with his name, the other labeled Trust. She explained, "Mike, the rules are rigid, but not unbreakable. Imagine you could build an invisible wall. To the IRS, DataFlow moves to a parallel universe. Out of your estate, out of their reach, but you still get to enjoy the income." She walked him through the blueprint of an intentionally defective grantor trust, or IDGT. Mike seeds the trust with $2.5 million in cash, a token to ignite the structure. Then, he sells his $22.5 million share of DataFlow to this trust. For income taxes, the wall is invisible. Mike still sends the IRS a check for DataFlow's annual profits, as if nothing has changed. But for estate tax, the wall is iron, thick, immovable. The company is out of Mike's estate. In exchange, the trust issues Mike a promissory note, a legally binding IOU. The trust owes him interest each year, which he can use for retirement adventures or as a cushion, all without raising the IRS's antenna further. The IRS ignored the trust for income tax purposes, but honored the wall for estate and gift tax. He signed the trust documents, executed the sale, and, most of all, froze his estate's value at $25 million. 5 years blurred by mergers, late nights, celebrations, and crises. Under his children's management, DataFlow's value doubled to $50 million. Yet the lion's share of that growth was safely behind the trust walls, never threatening to cross into his taxable estate. Mike enjoyed his retirement. The promissory note paid him well, and each year he marveled that wealth was not being whittled down by federal estate taxes. When the final accounting came, that $25 million in new growth was passed to his children untouched.